Hello everyone, and welcome to our first podcast of 2016. I'm Gabriel Stein, Director, Asset Management Services. I'm sitting here with Martin Beck, Lead UK Economist at Oxford Economics, and we're going to talk about the Bank of England's decision, or rather non-decision, today, the 14th of January, when they decided to leave monetary policy unchanged. Martin, the decision itself was no surprise, but you note in one of your comments on this that the continued hawkishness of Andrew McAfee, one of the MPC members who continues to want to raise interest rates, was a surprise. I think this calls for two questions. First, why is he so hawkish? And second, why should he today not be hawkish, in your opinion?
Well, Andrew McAfee's stated argument for being hawkish is that he thinks cost pressures will pick up sooner or later, and it's better to head off a rise in those pressures now. And in doing so, it means that rates can rise at a slower pace in the future. But I wonder if another reason, a more cynical reason, is he's just embarrassed about the thought of having to change course on his desire to raise rates. I mean, we did see a period last year, at the end of 2014, where both Andrew McAfee and Martin Weil, another external member of the MPC, consistently voted for several months in favour of raising rates and then reversed course. And I wonder if having made that turn once in the past, that Mr McAfee might be embarrassed about doing so again.
Well, isn't this an instance where the so often quoted Keynesian statement, when the facts change, I change my mind, what do you do, sir? I'm not sure if he actually ever said that. Shouldn't this be applied? I mean, what is it more important to be consistent, or is it more important to take account of current developments? Should he, in your view, still be hawkish, or is there a clear case for Andrew McAfee to join the majority now?
I think there is. I mean, if you look at inflation, the MPC are now saying they expect CPI inflation to run at only 0.5% by the middle of this year, and that's still massively below their 2% target. They expect inflation to only rise to 1% by the end of the year. Equally, if you look at variables like pay growth, that's slowed down recently, and it's still at a level, when you combine it with productivity rises, it's not really consistent with the 2% inflation target. Equally, activity has shown signs of slowing recently. Today, in the minutes of the meeting, the MPC said they had downgraded their forecast for GDP growth in Q1 this year and Q4 last year. So no doubt when the next inflation report is published in February, we'll see the committee's forecast for growth, inflation and jobs growth and pay growth tick down a bit. And that all points in a dovish direction.
Now we have at the end of last year or last autumn, we changed our own forecast for when the MPC will raise bank rate from the second quarter of this year to the fourth quarter. Do you think we are going to stick with that, or is there an argument that bank rate may actually be unchanged throughout 2016?
I think there's a reasonable chance of that. I mean, our central forecast is for a rise at the end of the year, but certainly if you consider the risks at play in the world economy and in the UK, then there's certainly a downside case to suggest that rates might not rise until into 2017. And you know, we were one of the first forecasters to change our call in terms of pushing it back, but it is the case now that some other forecasters are putting their central estimate into 2017. So whereas before we were maybe ahead of the curve, we're probably level pegging with a lot of other forecasters now, but others are a bit more bearish than we are.
Well, annoying as it is to be part of consensus, we shouldn't let consensus drive our forecasts, so we stick, I suppose, to what we think is right. Now, let me ask you something else. You said the bank will downgrade its growth and inflation forecasts for the year. Now, our forecast, our base scenario for 2016 is that the UK economy will be the second strongest of the G7 after the United States. Now we are modestly bullish on the eurozone, potential for upside surprises. Does this mean that we think the UK will no longer be the second strongest economy, or is it simply that the difference between UK and eurozone growth is such that even a bit lower here and a bit higher there, and we're still going to be number 2?
I think it largely comes down to differences. I mean, last year the UK grew at just over 2%, the eurozone at just over 1%. So although we expect the differential between the two economies to narrow in favour of the eurozone, and that still points to growth in the UK running a fair amount ahead of the eurozone, and that really comes down, in our view, to the story for the consumer. A couple of months ago, we expected that inflation now would be rising quite quickly. The Chancellor had announced big cuts to welfare spending to come into effect in April, but it looks like now that the consumer is going to get a bit of an extended holiday. Inflation is set to rise much more slowly than we expected because of the recent fall in oil and commodity prices. And equally, the Chancellor has now backtracked on his cuts to welfare spending, so that will provide some fillip to consumer spending over the next year.
But he continues to talk a tough talk, doesn't he, Mr. Osborne? Talking about disasters if we don't stick to austerity.
I do wonder if he's maybe covering his back for the forecast which the Office for Budget Responsibility present in the budget in March. I mean, to the extent those forecasts downgrade their expectations for growth and for public sector borrowing, then by warning now about the consequences of international problems, and Mr. Osborne can, it gives Mr. Osborne a very good excuse for any forecast downgrades.
Getting back to the Bank of England, bank rate to rise in the fourth quarter of this year, therefore, but given what you just said about inflation and growth, it's not going to rise by very much, if at all, is it? No,
I mean, we're expecting a quarter point rise at the end of the year, but we're still only expecting rates to end 2017 at about 1.25%. So we're only expecting a gradual increase in bank rate, and that's certainly consistent with what the Governor of the Bank of England, Mark Carney, has been talking about. He's predicted that even when the economy fully returns to normality, bank rate will only be around 2%. And that's a view we would concur with. So by the end of the decade, we're not expecting rates much more than 2%.
But if at that stage the rate of inflation is also 2%, which I assume we have to expect, because otherwise why would the bank raise rates? That means we're still talking about almost zero real interest rates. Isn't that a very, very dovish forecast? Because historically, if I'm not altogether wrong, the real bank rate has averaged much closer to 2%. So what you're saying is that monetary policy in Britain will remain extremely accommodative and loose, even when the economy is back at normal speed, as it were.
I guess that's true partially, but one reason that the Bank of England has put forward for their expectation that bank rate will stabilise at a low level is that the spread between bank rate and market rates will remain higher than before the financial crisis. So in order to achieve a given market interest rate, you can do that with a lower level of bank rate. So that's one reason why maybe looking at the past and the level of rates then doesn't provide a particularly good guide to the future.
One last question. Once again, for I don't know which meeting, the Monetary Policy Committee decided, and unanimously decided, with McAfee agreeing, by the way, not to try to sell any of the £375 billion worth of assets they bought as part of the bank's quantitative easing. And now what we've seen in the United States is that the Federal Reserve decided that first they will raise interest rates, possibly to as much as between 1% and 2% before they start tinkering with the balance sheet. What is the Bank of England's attitude?
The bank's view is to follow in line with what the Fed is doing. And I mean, the Bank of England said in the inflation report in November that they didn't think they would start selling gilts back to the market until bank rate had reached 2%. And given our forecasts, which are very close to the banks, that suggests that we won't see any sales of the bank assets the bank have accumulated as a result of QE until towards the end of the decade.
Right. Well, obviously what we have to look forward to is another long series of Bank of England meetings where nothing happens. On the other hand, even though there is really no Chinese curse that says may you live in interesting times, boring times when nothing happens tend to be good times to live through historically. Martin, thank you very much, and thank you everyone for listening. We will be back, of course, with more podcasts in the future.